12 must-read books for every investor in 2025. I'll start off with the absolute vital books that we all need to read if we're serious about investing. Then we'll move further down the rabbit hole and we'll talk about books that cover very specialized knowledge in the field of technical analysis. And then finally, at the end, we'll cover two very special books that offer you some deep thoughts and future views on the market. I hope you enjoyed this video. Welcome to the Smart Money, Dumb Money Show. I'm your host, Keith Richards. I'm President and Chief Portfolio Manager at Value Trend Wealth Management. And today we're diving into 12 books you must read in 2025. We're going to start off with the basics, and one of my favorites is a book by a man named Jim Otar. Jim wrote a book that dispels the myth of buy and hold, and now is the time to buy. There's times to buy and times to sell, as any trader knows, but Jim proved it through data. This is a chart of the typical all-equity portfolio. And this fat line here shows us what investors expect to earn on that equity portfolio if historic averages of returns continue on the S&P 500. As they draw money out in retirement, you can see that the line draws down. Now, all these squiggly lines around here are the real-life cases. And that's one of the reasons why I like this book, because the projections that your local financial planner give you on projecting returns and the amount you will have left in your portfolio over a certain number of years of drawing money out are usually far removed from reality. As you can see, it really depends on when you invested. Sometimes your portfolio, like in this sector up here, will outperform expectations. Down here, you can see that many of the returns were well under the average of the expectations of most investors. So it really depends on when you buy in the market. If you're going to be a buy and hold investor, you might outperform your expectations or you might underperform. Jim's book really points out the reality of timing in the markets. The next book I want to show you is a book that influenced me very early in my career. In fact, I sent a letter to this man, Stan Weinstein, telling him how much I enjoyed his book, and he returned a copy of the book signed to me in 1999. I read the book in the mid-90s and enjoyed it thoroughly. And the biggest thing I got out of Stan's book was put in my own books, and that is the phases of the market. Stan talks about all markets, whether it's individual stocks or indexes like the S&P 500, and how they move through basing, uptrends, topping patterns, and downtrends. I took that philosophy and incorporated in my own way of doing things, and it's really helped in my career of understanding how markets move. I would be remiss if I didn't bring up my own book, Sideways. Now, I wrote Sideways for retail investors just like you. What I tried to do was incorporate all of the most important things you need to know about technical analysis and make it simple and easy to understand for most investors. It's not a thick book filled with all kinds of goobly-gop. I get right to the point, as I'm prone to do in most of my teachings. In fact, if I were to start as a beginner in technical analysis, I would start with my book first. And that's not just an endorsement from me. Many others have enjoyed this book. In fact, Sideways is my all-time bestseller. I've sold thousands of copies over the years, and I think it should be in every investor's library. Now, if you really want to go further down the rabbit hole, there's John Murphy's books. Now, John Murphy has written a series of books on technical analysis. This one is on the futures markets. He's written almost an identical book called Technical Analysis of equity markets. It really doesn't matter which one you buy because the charts are all that matters. John's book is considered one of the Bibles of technical analysis. He covers everything, and it's just filled with charts and lessons. And you can see I've highlighted many pages. In fact, almost every page has a highlight on it. I highly endorse John Murphy's books, and he's always making new editions. This one is a little old because I'm a little old. The final book I want to talk about in this series of investment basics is Trading for a Living by Alex Elder. Alex talks about many of the subjects that I do in my own book, Sideways, but he takes more of a trader's slant. So he covers things that I do not in my book, such as stop losses. I recommend every investor add this to their investment library. The next series of books, we're going to talk about specialized knowledge within the field of technical analysis. There's some great books out there that will teach you some of the very specialized parts that make up that great field of technical analysis. We'll start off by talking about chart patterns. Thomas Bowski has done some historical data work on every chart pattern imaginable. And this book gives you the data on how accurate those chart patterns are. For example, he'll tell you how accurate a double bottom is in predicting whether the market is making a bottom and about to move up. He gives you statistics galore covering every type of pattern and formation you can think of. I recommend it not as a bedside reading table type of book, but a book that you will refer to whenever you spot a pattern on your charts and want to know how likely that pattern is to predict the next move. The next book we'll talk about is Martin Pring's book on momentum. In Mr. Pring's book, he does a deep dive on every momentum indicator you could possibly imagine. Just one example. Here he is comparing the Japanese yen to the stochastics indicator. But instead of just taking one view on it, he's taking a look at different variations of stochastics, including the time frame, the look back period, and that kind of data to explore the best way to apply the stochastics indicator to a given price chart. It's a deep dive into momentum, and it's definitely not for light reading. The next book to talk about is one that I'm sure many of you are familiar with. In fact, people that buy my book Sideways often buy it in conjunction with this book, Brooke Thackeray's Annual Guide to Seasonal Investing. Brooke is a real expert in seasonality investing, and I've known Brooke for about 20 years of my career, and I can tell you this man is a real data cruncher if there ever was one. Brooke's book is very interesting because you can open the book to a given month and see what sectors should be hot, what sectors should not, and how you should play them. The data is all here, and I can't walk you through it all because each individual page has a plethora of information, but he'll cover the sector, he'll cover the individual components of that sector, and he'll give a summary right at the beginning of the book. I get Brooke's new guide every year to give me guidance on sectors and ideas that I should be looking at. Every investor should have a copy of Brooke's guides in front of them. Our next book in the specialized knowledge department is my own book, Smart Money, Dumb Money. Smart Money, Dumb Money is a comprehensive book on using sentiment, which is a contrarian indicator of when to buy and when to sell. Now, what do I mean by contrarian indicators? When people are too excited about a particular stock, sector, or the market, that's actually a bad thing because, as we call it, the elevator is getting too crowded and eventually the cable snaps. The reverse is true as well. When too few people are bullish and everybody is panicking and selling, this is the ideal time to buy. John Templeton once said, to buy when others are despondently selling and to sell when others are gleefully buying reaps the greatest rewards. Or at least he said something pretty close to that. So my book gives you quantitative tools on how to identify those peak moments of fear and greed and to fade that trade. Fading, as you might remember, means do the opposite. So I'll just open the book to a couple of things, but really this book is filled with an awful lot of indicators that if you're interested in the subject of sentiment trading, this is the book. I put markers so I could find a couple of the easier ones for you to take a look at. One of them you've probably seen me talk about before if you follow my blog at valuetrend.ca, and that's the VIX. Now the VIX is sometimes referred to as the fear index. All it does is it shows option premiums, and when option premiums are high, that means investors expect higher volatility on the market. When option premiums are low, that means investors think there's going to be lower volatility on the market. Well, again, this tells us if investors are thinking there's going to be higher volatility, that probably means they're fearful, and it tends to coincide with market bottoms. The reverse is true. If there's low volatility premiums built into the options market, it usually means that investors are complacent. So you can see here, high premiums mean too much pessimism, low premiums means too complacent. And what you will find is when these levels are hit and stay there for prolonged periods of time, that can indicate a market top or a market bottom. One other example of using contrarian indicators, and like I said, I think I name about 30 or 40 of them in this book, but here's another one that's kind of interesting, and I named the book after it, the smart money, dumb money indicator. Now what this is comparing institutional and very sophisticated investors, commercial hedgers, that kind of investor, to retail investors. Now, not to put down retail investors, but retail investors are the least sophisticated investors on the market. And when retail investors are excited about the market, and at the same time, institutional investors and commercial hedgers, who are considered the smart money, are not excited about the market, we should be concerned. So whenever this indicator gets too low, that can indicate that the market's getting too excited. But where I see the smart money, dumb money being most useful is at extreme low confidence levels. Take a look at this chart. You can see that when investors spread between low confidence of retail investors but high confidence of smart investors are reached, the market tends to make a bottom, and this happens over and over again. My book gives investors many tools within the field of contrarian investing to help you become a more accurate market timer. Our final book in the specialized knowledge department of technical analysis is Steve Nison's classic Japanese candlestick charting. Now, he's done other versions and follow-ups to this book, but the original book is the classic. And like I said, I've been in this business for 35 years, so I've got a lot of the originals of these classic books. So I'm going to open up this book and just give you one example of Japanese candlestick trading as described by Mr. Nison. Again, for people wanting the high-level stuff, you can go to my book Sideways, because my book covered the most important parts of candlesticks that you need to know. But if you want a deep dive, Nison's book is the Bible. So, just one example. Here we have one of the classic topping patterns that I talk about in my book, as well as my technical analysis course, but Steve gives us much more detail than I will ever cover in my book or courses, because this book is for people that like going deep down the rabbit hole. So here he presents a hanging man and the follow through on that bearish candle. I recommend Steve Nison's book as the go-to definitive book on Japanese candlestick charting. The first of the two books that I want to recommend is that every investor read Larry McDonald's newest book, How to Listen When Markets Speak. Larry does some big picture work in this book, It's actually a fascinating read. It's easy to read because he keeps you so engaged, telling you the story of how markets are going to change over the coming decade in ways you'd never imagine. It's filled with many what I might call deep thoughts and charts and all kinds of interesting facts about where he sees things going over the coming decade or more. I think every investor needs to know this information, and I can tell you it's influenced value trend in the way we are looking at the world as investors. The last book we'll present today is one of the most influential books in my way of looking at the markets that I think I've ever read. I saved this one for last because it's a really interesting study. It's by Robert Prechter, who's known for Elliott wave analysis, and anybody that knows my style will tell you that I'm not really an Elliott wave believer, but that's not what this book is about. This book is about socioeconomics and how social trends influence the markets. Let's open the book and see some fascinating examples of how Robert Prechter follows trends of social developments and pits them against stock market trends. It's really fascinating stuff. Now, some of you might have heard of the age-old belief that women's hemlines on their skirts coincide with stock market movements. The theory came out in the early 1900s, and the belief centered around when people are feeling more adventurous, more positive, women's hemlines in their skirts would go up. And when people were feeling more conservative and more fearful, the hemlines would go down. Well, that was really the beginning of what Prechter's book starts to dive into with some more modern research. So one of the things that Prechter talked about was movies, the type of movies that come out during bull markets and bear markets. Movies can reflect, believe it or not, overall social mood and stock market mood. So happy movies like Mary Poppins came out when markets were peaking. Investors generally felt positive, and movies reflected that positive attitude. Scary movies like Freddy Krueger and Halloween come out when the market is feeling the blues. As Prechter notes here, historical social moods affect the markets, or in fact may be a reflection of the markets. He talks about baseball attendance, which tends to go up when we're in a bull market, and alcohol and tobacco usage, which tends to go up when the mood is negative and markets are negative. It's a really fascinating book. It's too much for me to describe in one short video, but I think for anyone intellectually curious as to why things happen on the market and what happens behind the scenes when it comes to investors' moods and how to identify some of these broader scoped moods that may reflect on the stock market, I think this is invaluable. And it's fascinating too. So highly recommend Robert Prechter's book, The New Science of Socioeconomics. That's my list of must-read investment books for 2025. I'm sure there's a lot of other books out there that I've missed, and I wouldn't mind hearing your thoughts on those books. Post them in the comments below. Love to hear your ideas. Thanks for watching. We'll catch you in the next video.